Good morning, everybody. Happy Thursday, um, October 15th. Hey, we're in the middle of the month. That's good news. We only have 4 weeks approximately, I guess, until uh, gosh, maybe it's 5 weeks until Thanksgiving break. I'm sure that you guys are looking forward to Thanksgiving break. I know I am, and and then you get, unless they change the rules, I understand that then you all get to everything else is online or stopped or something. I don't know exactly what I probably should check into that, find out what the rules are. Although I don't worry about coming on campus. Uh, sometime it would be uh, nice to know, not to get into some big discussion about it or debate, which is probably what it would turn into typically with me. Anyway, about it, sometime if some of you are bored and need something to do and would like to share, I'd be interested in knowing how the experience has been, uh, being on campus, taking classes or not, and being online or not. And I guess you're online with this class, so you are all online. Um, it would just be interesting to know your experience, what you thought about it. If you hope it ends, all this stuff, you know, the ends tomorrow, or you can take it for another semester or two, or however long it might last. Anyway, just rambling. That's something that I would be interested in hearing your opinion about, because I certainly have my opinions, but my opinions are, from a much different age. So,
I personally hate online classes.
do
Just
you?
saying. Yep.
Yeah.
I
I
think it's awful.
uh well, not to reveal too much of my own opinion, but I think online is nowhere, not even in the ballpark of being as useful as live classes.
Yeah, it
One,
makes it a lot more difficult to learn. I personally think so.
well, I appreciate that, sharing that. I do too. I think it's difficult. The technology gets in the way. The 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 lack of contact. I don't know. When if I was in a classroom and I could see all you, I think I would do a much better job for sure with what we have, the material and what we have to work with and all that stuff. So yeah, I think online is kind of a bust, but that's what we have, and it's what we're doing. So uh anyway, if there's any other neat stuff, uh experiences, you don't need to get too personal. I'm not looking for that. I'm just looking for general thoughts, maybe about campus environment and town environment in Blacksburg. Since I don't know if I shared with you all, so I lived there in Blacksburg for 30 30 plus years somewhere. And in the summer, I moved. I think this summer we moved down to Salem, and uh, part of the reason is our kids are grown and out of the house. We had a great big house and needed to shed ourselves of that, and also then we need to get closer to the church we go to down here in Roanoke County. And so anyway, we moved, and so I was in Blacksburg actually yesterday for some business, and I'll be there tomorrow for some business. But I sneak in and sneak out, and I don't get on campus, and I don't look at campus, or I don't see what's going on. And uh, I do know a little bit what's going on from the faculty meetings that I sometimes attend in building construction, the School of Construction. I attend those faculty meetings and hear them talk about all the COVID stuff going on, and So and when I hear about all this stuff, I'm glad I'm not there. Those restrictions are restrictive for a reason, certainly. But anyway, let's get off of that stuff. Let's talk about uh, let's talk about financial statements. Uh, yeah, we have to slog through a couple more days of this, and well, and then we do accounting, which is slogging squared. So this makes the engineering economic analysis stuff almost seem fun, doesn't it? I maybe. Um, anyway, so here's some announcements. My stack of announcements this morning. Homework number 4, as you notice, maybe is posted. It's there's an announcement about it, and it's due at noon next Tuesday. That's noon next Tuesday, and it is what we're doing, and I'm gonna spend just a couple more seconds on that with the in-class exercise, which, by the way, you don't need to turn anything in. I was going to have you turn something in, but the homework is essentially equivalent to what we did. So so you don't need to turn in any work. It's for us to kind of communicate maybe and you get comfortable with making those ratios before you do the homework and have to do them. And there are, I don't know, you get to do 8 or plus or minus some delta, I don't remember, but around 8 ratios and kind of explain what they mean. That's your homework. uh, so anyway, that's due next Tuesday at noon. That should give you plenty of time. Uh, I noticed the syllabus may need a little adjustment again already. A slight, small, but if I do, I'll let you know. And that's coming up. We're still plugging away on the midterms. That, like I said, that's going to take just a little bit of time. So please be patient with Mitch and me. And if you want to get impatient, don't get impatient with Mitch. You can get impatient with me. Mitch is doing Mitch's work. He's doing a great job, and TAs never deserve abuse from the students. If the TAs are going to get abused, they should get abused from their boss. And Mitch is not worthy of any abuse. I guess maybe nobody ever is, but that's now we're getting philosophical. So anyway, if you're upset about something, come to me, please. And if it involves Mitch, I'll get with him, but it generally will be me. Buck stops here, right? But I appreciate your patience as we work through those midterms. I have adjusted Canvas a little bit. You may or may not have noticed, probably not, but I've split up the assignments into some, I guess they call them groups. Groups is a word I don't like. So anyway, I've adjusted some things on Canvas. I may adjust some things a little bit more. I will repeat one more time, reiterate, let me say, that on Canvas, you can look and see what your scores were for particular activities. Don't look to Canvas for a grade, a calculated grade or anything like that, because it's not quite set up that way. And I don't, I haven't put anything in to make any calculation worthwhile. Once I finalize midterms, can I release tentative grades based off the calculations? Well, yes and no. I guess the only difficulty with that is communicating those to you. So if I can figure out a way to get that done, and maybe it's create an assignment where I just, in that assignment, it's a dummy assignment, I just put a grade or something. Yeah, I can do that. Let you all know where you stand. I know you'd like to know where you stand, so I'll get that done as soon as we get those finished. And thanks, John, for bringing that up. Okay, what else? Oh, I have, in the interest of kind of further, well, two things, further exposing you to these financial statements and the value of them. I've posted 3 different annual reports, corporate annual reports on Canvas, and I'm gonna just glance at a couple of them this morning with you, just to show you some things. 2 different companies. You may have heard of them. They're very large. They're Sterling is construction. They're from Texas, and they're over $1 billion company. And then Granite, who's from they're based in California. They're huge. They're into mining as well, and they're over a $3 billion company. And I want to just show you a few things, a couple of things, and talk about those, highlight a couple of things for you, because a little bit later, and I'll talk about this later in class today, a little bit later, you will get, I'm going to show you, I haven't actually assigned it yet, but I'm going to show you, and I'll be posting it up as an assignment, and probably first of next week or something. A little longer term assignment, you'll get till Thanksgiving to get it done, but on going out and finding a company that has you can get a hold of their financial statements, and for you to do some analysis of that in comparison to industry standards. So we'll look at that here in a little bit later today. Okay, that's all my rantings, and it's all of my announcements. So what do I want to do next? I wanted to let's go ahead and finish where we were left hanging, and I don't want to spend I'm not going to spend much time on this, but let's go back to that Excel spreadsheet, big W, and as we look at that and look at those last couple of ratios that we discussed, and I apologize, I can't remember who pointed out that, yeah, actually, I did have a wrong ratio, and we'll look at what that ratio is. So I think this is not it. There we go. That's it. There's a spreadsheet. There's where we left off, and we left off with number 12 here, and that was the assets to revenues ratio. And remember that that's the total assets to revenues. Now the assets is from the balance sheet, and the revenues are from the income statement. And that means that we're going to need to, let me hang on a second. Pardon the interruption. I need to quit program on my computer. And since we're using both balance sheet and income statement, we need to use both ends of the balance sheet, both years, and average those. So the total assets, let's calculate this number. The total assets are the 1 million plus the 835,000 divided by 2. Okay, and then we need to divide that by revenues, and There's our revenues, 3.7 million. And there it is, 0.25. So that's that ratio. And you'll get to do that. I think that's one of the ones I chose for your homework. I can't remember exactly. Okay. And then the next one, I wanted to polish this up and talk to you a little bit about, because this was the working capital turns. And first of all, we need to talk a little bit about working capital. You'll hear that term thrown around a lot. And working capital is, well, it's current assets minus current liabilities. So it's hang on just one second here. Current assets minus current liabilities represents, think about it as, remember your current assets also includes things like receivables, right? In your current liabilities, things like payables. So it's not cash, but it does represent the money that you have during the year to work with. So if your current assets are greater than your current liabilities, you have money called capital to work with. That's the excess funds that you have during the year to put to work in your firm. Working capital is a very, very good thing. You don't want to be in a working capital deficit. You don't want to have your liabilities exceed your current liabilities exceed your current assets. Now, you know, there's going to be times when maybe that's you're temporarily in that kind of fix, but at any rate, so working capital is current assets minus current liabilities. And then the working capital turns is a measure of how that's put to work, how much you can put that to work. And the definition of the working capital turns is the revenues, your net revenues divided by your working capital. So remember, the revenues are what's coming in, and if you divide that by working capital, that kind of gives you an idea. The working capital as kind of a component of your revenue, how often that that working capital is returned through the revenue stream. And a lot of industries don't have this issue, but you'll notice in the text that it subtracts subcontracts from the revenues, from the revenue stream. And that's because subcontracting is a different, you know, is a different sort of animal than most companies see. And since you don't pay you don't use your working capital for subcontractors, it's not appropriate to have it in the numerator as well. So let's calculate this, and I want to do it in a couple of steps here. So working capital, again, this is a term that's used a lot. Now, notice again that this is a ratio that uses a balance sheet, some balance sheet numbers, and revenues from the income statement numbers. So the working capital then is going to be the average of the current year and the previous year. Current assets minus current liabilities. I don't know how many parentheses I'm going to need here. Current assets minus current liabilities. Let's see, where's my current liabilities? Total current liabilities. And I could divide those by 2, right? But that's the average to average. When I do this, let me make it easier. We can just let's do this. There's my current assets for this year, and let me add the current assets for last year. Where am I? I'm lost. Current assets for last year, I'm going to add those up. And then I'm going to subtract the sum of the current liabilities. The 423 and the 367. Okay, so, and then I'm going to divide all of that by 2. There's my working capital. So I could have also done assets minus liabilities for the first year, and added it to assets minus liabilities for the current year and for last year, and then divided that by 2. But you notice the signs would have all been the same. So anyway, that works. Trust me, my mouse stopped working. Trust me, that works. And that's our working capital, $200,500. All right, so now remember, in our formula, we need to take working capital, and we subtract from that. Excuse me. We would subtract from that subcontracts, and let me see. Those are down here in the income statement. Notice they have their own category under construction costs, subcontracting. And so that gives us all the stuff we need to calculate it. So this is equal to our working capital minus, I'm sorry, it's wrong. Revenue, I've got working capital in the brain. Revenue minus our subcontract amount. And then I'm going to divide that by the working capital. And that's same thing we had before, 11.2. So again, the revenue minus the subcontract is, and then divided by the working capital gives us an idea of that working capital put to work, generating that revenue. And as always with turns, you would like to see those turns up there. Turns are good. You like turns. I like turns. Okay.
What does that 11 actually stand for? Is that like, what does that ratio actually like entail?
Yeah. Well, it just says that during the year, we had revenues. Sorry, I keep going to my mouse and it's not connected. We have revenues of $3.7 million during the year. So but our working capital is well, and we subtract the subcontract, which is,
Yeah.
we can kind of pass that through. So it's 2.2 million perhaps, and so that's the revenue that's being generated. The working capital is, okay, our assets, working capital is current assets minus current liabilities. So it's the during the year sorts of extra funds that we may have available. So it is a picture of, from our assets and liabilities, our financial position, if you will, how is that assisting us in generating our revenues financially, not operationally, not because we've got people in the field doing good work and they're working hard, but this is, the liabilities are the things that we owe, things that we're using to generate revenues, and our current assets are those actual parts of our company, if you will, that we're using to generate assets, but they also have to handle the liabilities. So our assets are kind of dedicated to the current liabilities that we have to take care of, and then the excess of that, the working capital, is used to build the business. It's building and growing and getting work done in excess of what we owe. So the working capital, then, the amount, the 200,000 here, is the part that's being kind of the guts of our company, kind of what we own, put to work to generate revenues. And the more revenues you can generate from that, the better job you're doing in managing your assets. So if working capital was, let's say working capital was twice this, so that would mean that you had used twice the asset values to generate the same revenues, and that's not good. So you want to have, if you've got a really thin difference between assets and liabilities, so that you're kind of you're always kind of living life on the edge, if you will. That's an overstatement, but your assets just barely exceed your liabilities, so you're just getting stuff paid for, and you're living life on the edge. Even if you're living that way, if you can use that little bit of excess to generate a lot of revenue, that's a good thing. Not the living life on the edge part, but the ability to generate all that revenue. And that means you're doing a much better job in putting that little bit of extra asset over liabilities. You're doing a great job in putting that to work to actually bring money into the company.
Okay, and then just one last question. So is that 200,000 divided out throughout the year, or is that?
That's a good question. That's a great question. It may not be uniform, right? Remember, so
Okay, it just depends on demand of the money, really.
Exactly. So
Okay.
we're looking at those two different snapshots, and we're looking at the difference between those two different snapshots, in a sense. And and so we don't know. We don't have the detail to know when during the year the liabilities come due and stuff like that.
Okay.
That's a good question, and the timing of that is likely to affect, really how you're putting it to work to generate your revenues. So that's a good point.
Okay. Thank you.
You bet. Okay, so enough enough about that stuff temporarily. Anyway, you'll get a chance to do it on the homework. Um, pardon me. Let me see if I can get my mouse connected again. Let's look at something a bit different here. Ah, there we go. Okay, I want to quickly glance at these financial statements and annual reports, and I don't want to belabor these. Like I said, I posted 3 of them. I'm only going to talk about 2 of them, but let's see. But I just wanted to show you how what you will see some of these in this assignment you will get soon. But all publicly traded, publicly owned, when I say publicly owned, I don't mean government owned. I mean, you could go buy stock in these outfits. Certainly, all companies have to file with the Securities and Exchange Commission all kinds of voluminous reports. And these different filings have different labels and numbers, and they're for several different sorts of purposes. And private companies also have to file with the SEC, but they have much less. It reveals much less information. One of the problems with a publicly traded company is that you're beholden to your stockholders. As a matter of fact, I have a friend who owns, if you will, maybe there's a couple other people or backers, but not publicly traded, and owns a company. He's a tech grad, and anyway, it's a big company. They do a lot of work, hundreds of millions of dollars of work every year, and so it's not traded. And I've asked him on occasion, would you could take this company public, and you would be set for do whatever you want to do, buy your jet, that kind of stuff. And he of course, he's, even without selling it, he's well off, but he says, once you trade publicly, all of a sudden you're beholden to your stockholders and to quarterly reports, and you don't get to manage. You really don't own your company anymore. And so these companies that are public, it's a whole different ballgame than owning your own shop. It's completely different. So anyway, here's these annual reports are for publicly trading. Here's Sterling Construction. They're in Texas. I happen to know something about them, and very, very limited my knowledge of Sterling, but I lived in Oklahoma for a while, and had friends from Texas. And anyway, and of course, these annual reports contain important information, but also there's a good deal of marketing, if you will, going on with these. And there's the letter to the shareholders. Typically, your annual report begins with letter to the shareholders. And you've heard me mention like EBITDA. There it is again. This term, earnings before interest, taxes, depreciation, and amortization, is something that's very important in industry. And the financial people look at EBITDA very closely. And of course, it's if you take away taxes and depreciation, amortization, which is kind of a relative to depreciation. So interest and taxes, then what you're left with, you take that stuff away, what you're left with is really what the company's doing. not doing things for tax purposes, and the game playing kind of stuff goes away. So it turns out to be a very helpful number, but I think that EBITDA is not necessarily a number that's contained in the generally accepted accounting principles as a formal term. I could be wrong. I'm not an accountant, and I don't play one on TV. So anyway, you get that kind of stuff. Hello, shareholders. Here's your stuff. Okay, now here's their 10K is an SEC staple, and it's essentially all the financial stuff for the company. And notice that Sterling is incorporated in Delaware, where a lot of companies are incorporated because of the tax treatment that they apparently receive there. I'm not as sophisticated as to know all the details of why. But anyway, there they are in Woodlands, and there's their trading symbol. They're registered on NASDAQ. That's what's called the over-the-counter market. And anyway, a bunch of stuff here that we really don't care about. I wanted to, and you can easily fall asleep reading the details of these the 10Ks. Risks, they talk about risks, and risk is something that you all consider, and I would imagine have a good dose of in your classes. Here they're talking about availability of materials, concrete, steel, fuel, lubricants. Rapidly increasing labor costs would be a risk. Mechanical problems with machinery or equipment is a risk. Citations from government, that's a risk. So they've identified here. They probably had weather up. Yeah, there's weather conditions. So there's a lot of stuff in here. I needed to get to page 20. I'm headed to page 25. I got a long way to go, don't I? Hope you're not getting dizzy here. Notice there's selected financial data, and this throughout a report like this, you'll get snippets, you'll get subsets of larger, like this is a subset of the income statement, and this is selected, right, financial data. So they've plucked things out of there that they want to present here. And so these are big picture items. This is the, kind of the 30,000 foot peak. There's their revenues. So they're $1 billion company. These are in thousands. So that's $1 billion company. There's their interest expenses, income or loss before income taxes. There's their income tax benefit or expense. Notice they actually had an income tax benefit this past in 2019. For what reason, I didn't dig down to try to find that out. So their net income, actually with taxes, their income before taxes was only 14 million, and after it's 40. So that was a good deal for them. And then they obviously, because the annual report is prepared for shareholders in mind, they get to, okay, what about earnings per share? How much did you earn per share of stock that you owned? And there's the basic number, earnings per share, and there's diluted. Remember, we talked about diluted is if everybody converted all of their holdings to common shares of stock, what that would give more shares of stock to distribute the income to, which lowers the earnings per share. And there's how many shares are outstanding. And the weighted average means, of course, you've got some at the first of the year, some at the end of the year. What's the average? And throughout the year, you have, perhaps you've released more shares of stock. And so they've got, I guess I think this isn't in thousands, although it says in thousands except per share data. So I don't know if this is 26,000 or 26 million shares. 26 million shares wouldn't be a big deal. But anyway, so and then they've got a snippet of the balance sheet, their total assets, their long-term debt, and so they've got that summary. But I wanted to get to there's more summaries, oh, so why did I want to get? Oh, this is operations. Uh, Consolidated financial highlights. So they've still put a lot of things in here in kind of grand summary form, but this also includes the percent change from one year to the next. And so this is essentially their income statement. And notice that an awful lot of construction companies include at the bottom end of year backlog. Now, I don't know if you all have covered that before in another class or not. The backlog, of course, is the work that they've contracted to do that just no work has happened yet. So this is their backlog. Does not mean they're behind. It doesn't mean that it's nothing wrong. It's good. This just is a demonstration of, hey, we're an ongoing concern. We already for next year have a backlog of looks like $1 billion worth of work already contracted for next year. And so investors would want to see a large backlog. The larger the backlog, the more the company is growing, the more business is coming for that organization. And we didn't talk about backlog at all, but that's very important to an investor. It's not looking at the financial ratios. We're not going to get into backlogs, but yeah. Question?
Yeah. What does the NM mean?
NM is not meaningful.
Okay.
So, and of course, since in a previous year it was nothing,
Okay.
so you can't compare growth percent change to that. Yeah. So it doesn't
Okay.
mean New Mexico,
Yeah.
which, when you look at that, you're thinking, they must be doing business next door, but anyway.
No, I was just wondering. Thanks.
Right. Sure. So the backlog is something that you want to, it's a good thing. It's a great thing. The bigger the backlog, the better. Page 27, I wanted to, just to point out that throughout an annual report, you'll see a whole lot of financial stuff going on, and tables that we're not talking about necessarily in this class, but that are important and that investors want to see. And liquidity is an important, investors want to make sure that you are liquid enough, that you have cash or receivables, easy receivables handy enough that you can continue to do the work that's required. So so here we have net cash. So we have cash flow statements, and this is just a statement of liquidity and where they're getting their operating capital, the money that they use to get things done. And notice they lost a bunch of money in their investing activities last year. I don't know exactly what that means. They didn't lose money. I'm sorry. I'm thinking of a different table. So they invested. So it was cash out. They invested $410 million last year in something. This doesn't tell us what, but that was their investment. And the last thing in this, and then, I'm probably just going to not talk about the other one because this is awful.
Generally, what would a construction company invest in? like just per se?
Oh, there's all sorts of things. For example, they might want to buy a piece of an equipment manufacturer, right, to ensure
Okay.
flow of equipment to the company.
Okay.
Yeah,
So it's like a
Th-
personal interest. Okay.
yeah, and protection. They
Mm-hmm.
want to hedge against increasing costs, and so they might do that by their investments. And it also might be hedge investments for fuel. They may buy options
So
on future.
it's kind of like lobbying in a way, I guess.
Well, no, it's well, let me see. Uh, maybe you could say it's kind of like that, but it's not it shouldn't be considered a negative,
Mm-hmm.
like some people might think of lobbying. Um, but it's a forward looking. It's like insurance. Let's think of it that way.
Okay. Okay.
So, Southwest Airlines, for example, not construction, Southwest
Mm-hmm.
Airlines, one of the reasons that they have always made money, even when others were losing money, is that they were great with uh, hedging their fuel prices. And so they would buy futures contracts on fuel prices. They'd buy options on those that would guarantee the price of fuel that they paid. Even if the price went up, they had bought
Okay.
into lower prices. So,
Gotcha. Okay. That makes
and
sense. Thank you.
every company can make those sorts of investments. Every type of company can do that. It's just in construction, you're going to be companies are targeted in their investments uh, based on what industry they're in.
Okay. Thank you.
So anyway, and here's their balance sheet down here, and you'll notice that a lot of the things look familiar. They're just like things we talked about. A lot of them aren't. These VIEs here, variable interest entities, sounds what very confusing. Uh, Typically, these are joint ventures, and the variable interest doesn't mean the interest rate changes. It means that their Sterling's interest, their part of that joint venture might change over time. So they might get in a little bit more and get out a little bit more, and buy in and buy out. And it turns out that Sterling does a lot of joint venture sorts of things. So it's all over. You'll notice it is all over this balance sheet. So that's I don't want to belabor this. There's their income statement. Nope. Consolidated statements of cash flows. Sorry, I'm wrong. So this is their in-depth discussion of cash flows and where the cash is coming in and where the cash is going out. So anyway, that's in a bunch of financial terms here that I struggle to understand myself. Uh, so that's just a brief example of these uh, annual reports. I really wanted to go through Granite's. I might just throw up. Let me throw up. You might be. Oh, I can't do that yet. I don't think. You might be ready to throw up at this point, looking at all this. Yeah, I didn't. I thought not. Okay, so I think I'm sharing this. It looks like I am. Granite is, look, these guys are heavy equipment, infrastructure stuff. And of course, they talk about the needs for their business here, because bridges are crumbling and infrastructure's, crumbling. And the investment needed to meet current future demands for wastewater treatment over the next 2 decades, 271 billion. So they're selling the people who might want to invest in them that, hey, we're the guys. There's a whole lot of business coming. And would you buy a used car from either one of those guys? And so the top notch, here's the results that they think that an investor would want to, or a potential investor would want to, or a current investor would want to see, and they're going to present those way early, right? So $3.3 billion in revenue. There's their gross profit, $389 million in profits. Earnings per share, diluted, adjusted, or well, we're not going to get into adjusted. EBITDA margin, and so again, as a construction company, if you're looking at investors, yes, the revenue is important, but if I'm going to buy in, I care what the future brings. And so this backlog is very important. Notice that their contract backlog is already larger than their revenues for 2018. So and now that contract backlog doesn't mean it's all going to be 2019 stuff. Some of those contracts, I'm sure, with the size of Granite, are going to go to out years. But anyway, I did want to get to page 8 for some reason. And why is, oh, maybe this is page 8. Just their financial highlights. This report was done right. Boy, it's just very impressive. Anyway, and you can see the this is much the same information that was on that first page. And last but not least, if I can get there quickly, if I want to go to F3, in the very back is all of their stuff. And here's the details of their balance sheet, consolidated balance sheet, and you'll see some stuff here. Property and equipment, equity and construction joint ventures. So they have some joint ventures too, but they do a whole lot of their own stuff. I wanted to point out one thing down here, and that's goodwill. You know, goodwill is I struggle. I can't tell you. I wish that I understood it better than I do. I tried to understand it once and I just couldn't figure it out and gave it up. But goodwill is actually an asset, and it's an asset based on the performance of the company, contracts it has, how they come up with a financial number. I just can't quite figure out. But goodwill is something that you can buy and sell and amortize, and that is you can spread out that over a number of years. So you'll see that sometimes, goodwill, and it is an asset. It certainly is an asset, and it's not. Well, I no point in me even diving into it any further. You'll just see it sometimes. It's an asset. It's considered by the GAAP, the generally accepted accounting principles, as an asset, and the accountants know how to make their magic and determine what that value of that goodwill is. So enough of that. Let's we need to look now at a little bit of detail on income statements and pro forma sheets. So we're going to take a 5-minute break. 5. I'm going to warm up my coffee, and you all can stretch or do whatever you might need to do. And we will be back here at 9 o'clock to pick up on those last couple of topics. Okay, 9 o'clock. Let's get back to it. I want to go back to the spreadsheet and look briefly here at the income statement and make a couple of comments. Notice that we have these percentages here, and it turns out that those percentages are very, very helpful. And we'll talk a little bit more about those in a second. But how helpful they are. But notice that they're formed the percents. So this means that construction costs, materials are 19.3% of revenues, and labor is 24.2% of revenues, and subcontracting, all those are almost 40% of revenues. And then equipment and other, this is our equipment costs, what percent of revenues. Again, we're still talking about revenues. What percent of revenues are each of these? Our gross profit, same kind of deal, right? Overhead, what percent of revenues is overhead, all the way down. So our profit after taxes, our net profit, is 2.1% of revenues. So, okay, so it is what it is, right? We can perform these calculations, and it is what it is. Well, financial performance, of course, is something we've been talking about. And financial performance is a surrogate measure, if you will, for corporate performance, organization performance, company performance. And we are inferring, we're implying, I guess, that I think we're doing both. Anyway, that these financial measures, that by looking at that financial performance, that gives us an accurate picture of company and corporate performance. And indeed it does, especially considering that when you're financially sound, you're in business and you're doing well. When you're financially unsound, you're going to go out of business. So finances are very important. And we've looked at ratios. We looked at all these different ratios, and the quick ratio, the current ratio, working capital ratios, and stuff like that. Well, this is another measure that can help you in managing the organization. And these percents here, percents of revenue. For example, if you see from one year to the next year, remember the income statement is the movie. It's over a period of time. So you've got, this is a year's worth of picture. And then next year you'll have next year's picture. And if these percents grow or decline, they change in any way, you might want to question, gee, why is it that labor costs this year were 24.2%, and then next year you find out that they're 38%? Why? What's the reason for that? Why is it different from one year to the next? Now, it may be a good different. It may be a bad different. If it's a good different, you might want to ask yourself, gee, that's great. What can we do to continue that? What is it that we did that caused that good news that then we can use to generate good news next year as well in the same way? If it's bad news, you want to solve that problem. Why is it that our costs, that cost went up so much? Maybe you have a problem there. At least you should investigate. at least you should look into it and try to determine the changes in these percentages. So that's enough said. Enough said on that. We'll get a chance to talk a little bit more about those things in a little bit. So more and more ways that you can measure your performance, and we don't want to get stuck with certainly looking to the past is important. Trying to understand what has happened is important, but now we want to think about going forward, and we want to look at the future, and that looking at that future is where we now need to look, and we're going to look at these. I'm going to go back to PowerPoint, and this is this set of slides. Pro forma analysis is this subset of my big PowerPoint file is posted on Canvas. So you have this, and the pro forma analysis, signified by the big arrow on this slide, is looking to the future. And we now want to say, okay, now we certainly there's a management component to taking the numbers that we see that have happened, that we need to make some changes. We need to make some adjustments. We need decisions that will drive us forward and not backward. Right. So we've got those management decisions. But now we want to look at what would our estimates be for this next time period, financial period, fiscal year, whatever the case may be. We're going to be looking forward. What do those numbers look like looking forward? And now you all, many of you maybe have already taken cost estimating. And if not, you will. Many or most or all of you will take cost estimating. And there's a bunch of great tools in cost estimating. This is not that. This is estimating, and it's estimating a financial picture without the cost estimating sorts of details. I admire people who can do that job well. Anyway, so these are steps that are often and should be taken in performing pro forma analysis. We get the typical relation between revenues and sales driven accounts. It's you've got new sales that drive your revenues, and then there's doing the work that drives the revenues as well. So that relationship between sales driven and revenues from operations, we need to estimate that relationship. Fixed burdens. So what's coming up? Interest, except for maybe current liabilities, short-term borrowing, what your long-term picture should look like for your long-term liabilities. What interest you're being charged on borrowing, on debt, stuff like that. And taxes, you're going to need to make some sort of estimate on the taxes you pay. And remember, we haven't talked much about taxes, but corporate tax rates can be, you can be paying 1/3 of your income for taxes, or more if you include taxes such as payroll taxes. So that's important. You can forecast your revenues. And this gets back to, again, we're not going to explicitly use that term later, but backlog, right? When you have a backlog of work, that automatically goes into your forecast of revenues. Sales-driven accounts, based on forecasted revenues, estimate your fixed burdens. What are your fixed burdens? Well, we've got plant and equipment and things like that. Those are fixed over at least a year period. And then you're going to build, based on these estimates that you make, build a future period income statement and balance sheet. So you would have an kind of an estimated balance sheet for the end of next year, an estimated income statement for the end of next year, and how all that works. Now we're not going to be experts at this. We just need to understand how it's constructed. So here's those. Here's our income statement. So this is like we just looked at with those different percentages, right? And so right here, let's look at this. There's our revenue, sales revenues, cost of goods sold. We have a cost of goods sold that was $600. So that represented 60% of revenues, right? In year zero, that was the base. So if we forecast sales revenues to grow by 5%, then we would estimate our cost of goods sold, which is 60% of revenues back in the base year, to be 60% of the new revenues. And that gives us $630 in cost of goods sold. You kind of get the picture. And therefore we can derive our revenues, revenue less cost of goods sold, or our profit, gross profit, with subtracting one of those from the other. Our general overhead was 10%. So our general overhead next year we'll figure at 10%. Now, this would imply, right, that gee, what happened last year drives these percentages for our predictions next year. Not necessarily. These percentages, 60% of revenues, 10% of revenues, don't necessarily, and I would encourage you not, they don't have to be based on last year. They could be based on a base year or a consolidation of several years in the past to get at what that average percent is. So this 60% may be an average over 3 or 4 years, a rolling average, right, of the past 3 or 4 years. So you can see how once you start the revenue, if you've got these percentages of revenue that everything else represents, once you plug in that new revenue number, the new numbers for everything else are going to fall out. And hopefully you can see how that will roll forward. And you can do the same thing with the balance sheet. And we'll talk a little bit more about this on Tuesday. Not much, because this, I think, is pretty straightforward. But you can, once again, you can build those percentages, help drive the new numbers for your balance sheet as well as for your income statement. And and there's the accounting system, which is where we're headed on Tuesday anyway. So that's kind of what the pro forma analysis looks like. We'll touch on it a little bit on Tuesday before we get to our account down deep in our accounting. The last thing that I wanted to show you, and this is a kind of a heads up deal, and I'm hoping that I have it. I don't think I do. Let me go somewhere and make sure I've got it on the top. There it is. Sorry for the delay. I know time's running short. This assignment is coming up. Just a heads up, this will probably be the first of next week. You'll have till about almost Thanksgiving anyway to do it. You're gonna pick a construction company, and you're going to then look at the financial statements for that construction company based on the sector, and you're going to form these ratios. So you're going to do your own analysis of that company, and we're going to compare it to industry, the type of industry that it's in, and compare those ratios. And then you can see, hey, this company's way out of whack here or way out of whack there. So just a heads up, that's coming. And I wanted you to know that was coming up for homework we're out of time. As usual, I rambled on too long. I hope you have a wonderful, marvelous weekend. I know it's going to get chilly. So enjoy your weekend. Don't forget about the homework. Knock it out early and quick while this stuff's fresh in your mind. And I will see you next Tuesday.